Quick programming note before we get started today. Over the next several weeks, I will be moving to Australia. Video producer Aaron will be biking through Croatia. Big Al will be vacationing across Japan and Europe. And Joe will be enjoying his time in Arkansas and Minnesota. In our absences, I may run some encore episodes, some compilation episodes of previous content you may have missed, and some shorter episodes like this one. But everything will go back to normal in July. We're pretty sure. In the meantime, Tariffs killed Carl's investment portfolio and left him wondering if he should claim Social Security early. Joe and Big Al spitball for him today on Your Money, Your Wealth podcast number 531. Kelly and Steve in Pennsylvania ask for a three-fer spitball, when to claim their Social Security, whether they should contribute to Roth or convert to Roth for that lifetime tax-free growth on their investments, and if they're on track for Kelly to retire in 3 years. To ask your money questions or to get a retirement spitball analysis of your own, check the links in the episode description. You'll see one that says Ask Joe and Big Al. Click or tap that link, and before you start your ask, make sure you watch my video telling you how to make sure that your spitball is a good one. Then send us a voicemail or an email. I'm executive producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
All right, we got a call or a email from Carl. No location from Carl here.
No, he emailed right? info@purefinancial.com, and he did not follow the rules.
Got it. He goes, hey, guys, just love your show. Drink of choice is now any IPA, and I drive a GLE 350. I'm 63, retired. My wife is 59, still works. We're on our way to a good retirement with $1.2 million in Roth IRAs, $1.8 million in traditional IRAs. Also have investments close to $500,000, returning at 7.5% per year. That's a pretty good return.
Wonder what he's in. Return.
My wife was planning to retire Q2 of 2026, but because of the tariffs, we've seen our portfolio, Roth IRAs and 401ks, drop over $300,000. I'm thinking about starting my Social Security benefits. Is this a bad idea? Also, our net budget is $96,000. Own our home outright, have no car payments, but have a HELOC if needed. Carl Benz. What is Benz? Is that like a Mercedes-Benz?
That is what he's driving. His GLE 350.
GLE 350.
50.
Well, I wonder what's returning 7.5% per year. I bet good old Carl wish he had all his money in the 7.5% per year bucket.
Or maybe that's what it was before the tariffs.
No, I bet it's some fixed triple net something that's going to blow up on him at some point.
Right. Private credit, maybe.
Yeah, could be. I don't know.
Yeah.
All right. So what do you think? Yeah. So his portfolios dropped $300,000 a year, or $300,000. So he's freaking out a little bit. He's 63 years old. Should he take his Social Security benefit? They'll give him about $3,000 a month.
Yeah. So first of all, just to do a little bit of math, he wants to spend $96,000 per year. He's got about $3.5 million, and he's got he'll have $33,000 coming in Social Security if he starts it now. So even without Social Security, Joe, it's a 2.7% distribution rate, which is a good rate, I think.
Yeah, but his wife 63. Is still working.
Right.
I don't think he needs any of the money.
Well, I suspect but she wants to retire in Q2 of 2026. I think that's what he's probably getting at is should I take it when she retires because our portfolio is down so much and I'm just going to be taking more from it. I think that's what he's getting at. And I'm going to say he doesn't need to. I think there's still plenty of assets. He's got to have some safe assets to draw the money from while the market is declining, like bonds or whatever's fixed income is at 7.5%, that kind of thing. But no, I don't think he needs to. He certainly can if he wants to, but I don't think he has to.
Yeah, I think this is the problem with people that don't necessarily have a true drawn out strategy. Is that, all right, things get a little bit shaky and what's my, parachute? Should I go ahead and grab Social Security? Here's the pro of taking Social Security early. Is that it's a less distribution from the overall portfolio. So you're saving more of the portfolio long term. The downside is you're locking in a lot lower rate for the rest of your life. So do you feel that the market is going to continue to decline for a certain time period and never recover? Or are you taking so much from the overall portfolio? If he was taking like 7%, 8%, or 9% from the portfolio and trying to bridge the gap to Social Security, it'd be all right. Well, now that's a little bit too much because as the market's declining and you're taking that big of a draw from the portfolio, it's hard to recover from that big of a decline. I mean, we're seeing declines in the market, but you're taking 2% out, and I don't think he's taking 2% out today. I think he's taking 2% out in 2026, which is another 12 months from now. And if you look at the volatility of the market, I'm not sure when he sent this in, but it might have been, all right, well, what's going on in the overall markets? This is a short period of time, right? The markets blip. You're going to have down years. You're going to have good years. 70% of the time, the market's going to go up. So I wouldn't make a decision to say, hey, because the markets are volatile today, I want to take my Social Security benefits. You still have to weigh this thing out. And I think Carl has a low distribution rate where I still think it makes sense for him to continue to wait until whatever plan, he decided on, prior to the volatility of the overall market.
I think you bring up a good point, Joe, which is a market decline or market increase doesn't necessarily affect your plan, right? You should already have your plan. If the market goes up, great. You can pull a little bit more out of the stocks. If it goes down, well, that's too bad, right? But you pull money out of your safe money, your bonds, you let the stocks recover. It doesn't really change anything else per se, especially when you have a low distribution rate like this, 2.7%. You've got the flexibility to stick with your plan, whatever it may be.
Yeah, I think he needs to be thinking about other things at this point. It's like, all right, if the markets are down, how should you be rebalancing the overall account? How do you manage the risk? Should you be thinking about, tax loss harvesting opportunities if he has non-qualified accounts? Should he be thinking about Roth conversions? Should he be thinking about more higher strategic things that will benefit him long term? By claiming Social Security early, it's kind of a knee-jerk reaction. I get it, though. It's like, okay, I'm seeing my portfolio drop $300,000. I don't want to touch my portfolio anymore, or I don't want to take as much from the portfolio. So why don't I just take this guaranteed income source of Social Security, and then that's going to save that portfolio because I'd like to see that balance at a certain level, right? Hey, I have $2.5 million or $3.5 million. Now that's worth 3.1, 3.2. It's like, wait a minute, I just lost 300,000 in a couple of weeks. That's way too much. Where's this thing going to go? And so, hey, that's why people go into cash. Right? It's like, all right, I got to stop the bleeding. Or they do other things like this that could hurt them long term by, maybe giving up some extra cash on the table, depending, of course, what his life expectancy is.
Yeah. And of course, the second part of this is if you take Social Security early, not only is it a lesser amount for you, but one of you will probably outlive the other one, right? And so then you're decreasing your spouse's benefit in the future. So yeah, I think we'd like to say, Joe, that unless you really need the cash, it's better to wait. Now, if you have health issues or you both have health issues and you want to take it early, great. Or if you just, in this particular case, it's not like it's going to kill them because they got plenty of assets. So it's almost a personal choice, but I wouldn't do it. I think I'd much rather wait and get the higher benefit.
Yeah, it doesn't matter really for him. Sometimes people write in and, hey, I want to take my benefit right away because I want the extra cash right now so I can go on vacations and I can travel and I can do different things while I'm still young and I'm still healthy and blah, 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 blah. It's like, yeah, then take it, right? You can run the math all day long and you can look at the break-even points that people want to think about or how much true dollars is going to come from the system, given certain life expectancy ages. But it's like, okay, well, how much money am I actually going to spend, on travel when I'm in my late 80s versus I'm in my early 60s? I want to see the world. I want to do different things. And it'd be great if I had an extra $20,000, $30,000, $35,000, in my pocket to do those things. Then go for it, right? Who cares what the number and how much are you going to bleed the last dollar out of the system that you deserve versus, all right, maybe you take a little bit of a haircut, but you enjoy your life that much more. I mean, so I think there's a dollar and cents side of things, and there's also the real life side of things.
Yeah, completely agree. I just wouldn't make a decision just because of the market. I think maybe that's what we're saying. If you want to, and the reasons you just mentioned, have a little bit more spending money right now, then great.
Planning for retirement is a challenge, just like the game of golf. Only 3.2% of retirees have $1 million in their retirement accounts, and only 1 to 2% of golfers annually make a hole-in-one. Luckily, you don't need a hole-in-one to win the financial game, but you do need a strategy. This week on a brand new episode of Your Money, Your Wealth TV, Joe and Big Al show you how to get off the tee, avoid the fairway hazards, and sink the putt to get through the retirement course successfully. And don't miss the golf tips, especially for the YMYW audience, from PGA professional Chris Riley. Find the links to watch in the episode description, then calculate your free financial blueprint to see if you're on the fairway for retirement. Input your financial details and it'll output a report that tells you how much money you're likely to need to meet your retirement goals and actionable steps you can take now to get there. Click or tap the links in the episode description to watch the retirement course. Can you hit a hole-in-one? On YMYW TV, and to calculate your free financial blueprint.
All right, let's move on. Let's go to Kelly. Hello. We would love for you to give us a little spitball analysis. I'm 57, husband 64. I drive a 2017 Honda Accord, and he drives a 2017 Toyota Tacoma. I usually only drink on vacation, and I like tropical drinks. Yeah, looks like Big Al's got a little tropical drink right behind you. A little Malibu.
Little Malibu, yeah, that's right.
Yeah,
Kahlua rum is the other one.
What's the other one?
Yeah, you got Malibu, and then the other one is Kahlua rum, dark rum.
I never heard of that.
Kahlua is made here right on Kauai. It's actually very popular rum these days across the United States.
Oh,
we were wondering if you were going to notice, and no surprise, of course you did. There's alcohol in the shot.
there you go.
Are you much of a rum drinker at all, Joe?
No.
No,
I had Mai Tais in my honeymoon, and I almost got divorced.
That's because you had too many.
That was the end of that. All right.
But you kind of have to be an island guy to like rum, I think. And
Yeah.
you're not much of an island guy. You like Minnesota, cold places,
Yeah,
right?
yeah. TD Army. Little schnapps.
Right.
Yep. Yeah, I get like island fever. I get vertigo. I was just there a couple months ago.
Yeah,
And
I know
then
you
it's
were.
like
It's just not for you, is it?
I guess not.
Yeah.
All right.
You
So
got-
Kelly's
what-
husband, he enjoys the IPAs and always tries to get something local. All right. He's retired and gets a lifetime pension of just over $4,000 a month, no COLA. My survivor benefit would be $1,600 per month. He will be starting Medicare this year. I'm still working, hoping to retire in 2027 when I turn 60. I will be able to stay on his health insurance until I reach Medicare age. We will only need to get dental and vision privately once I retire. I make around $80,000 a year. We have no debts and the house is paid off. We plan to stay in this house long term. Our expenses are approximately $6,000 a month, and we do like to travel, so that will increase once I retire. We are healthy and hope to be able to travel for many, many years. Our kids are grown and financially independent. We got a cash in a high yield savings account, 100 grand. 401ks is 425,000. Roth IRAs, 86,000. Brokerage account, 100,000. Stocks and crypto, 14K. Total is $728,000. Our current plan is for Steve to take Social Security at 67 when I retire. We can live off his pension and Social Security. My questions are, 1, when should we take Social Security? Is this a good plan for him to take it at 67 instead of waiting till age 70? 2, should I be putting all my 401k contributions into Roth instead of splitting it? 3, should we do Roth conversions? If so, when? God, this is very specific.
It is.
She wants a dart on the dartboard rather than a spitball.
Yeah. It's not a spitball here.
And you better get a bullseye.
This is like written recommendations. I got to get compliance approval.
Right.
Thanks so much for your help. Love the show. Listen to it regularly. All right. Stephen Kelly.
Okay.
All right. When should they take Social Security? So 67. I have no idea why she came up with age 67 for Steve. Because Steve is 64. She's not going to retire until age 60. She makes $80,000 a year.
Well, that's because he'll be 67 when she retires, 3
So
years
when
from
she
now.
retires, he wants him to take Social Security
Well,
to
she's
kind of
asking.
help plug the gap there.
That's what she's asking, right? And
Got it. Okay.
so
That makes sense now.
if he doesn't take Social Security, they want to spend 72,000 a year, and they would have 48,000 coming in from his pension, shortfall of 24,000. So here's the math. You take 24,000, you divide it by your total liquid assets, in this case 728,000. You get 3.3%, and that should be fine, right? That's under the 4% that you want when you're retiring in your 60s. So I'm okay with them not taking Social Security. But again, it's a little bit like we talked about on the last question. It's a little bit more of a personal choice. If he wants to take it, that would be another 33,000 of income. That would essentially cover their expenses.
That would save the portfolio. I would
and,
take
and save the portfolio.
Yeah. I think this is such a different case though, because they got 4% coming out. They're wanting to travel more. They're very healthy. It's like, well, if we're traveling more, we're going to spend more. And the other guy, I think it's 3.5%, but then you have taxes in front of that. You're pushing 4. I'd much rather have the cushion taking the Social Security, and then if you want to travel a little bit, you can take a little bit more. I mean, the benefit, you get an 8% delayed retirement credit for a couple more years. So the longer that he waits, maybe you take it at 68 just to see how that first year goes. And then if it feels like we might be taking too much, we might be spending too much, you can always turn Social Security on at any month. So instead of a hard 67, it's nice to delay it, especially if they're really healthy, because they'll like the higher fixed income 3 years from now, or or 3 years after they claim. So I would test it. I mean, I don't think there's a hard fast rule here. I think it makes sense to take it any time between 67 and 70, but you got to live your life now that she's retired, no income's coming in, and just see how you adjust, because that's why most people take Social Security early, Al, because they want at least some sort of fixed income coming in.
Right. Yeah, I think that's right. Anywhere between 67 and 70. I personally would, in this situation, would probably take it at 70, just because just doing the math, it would add almost $10,000 more of income for life. Right. And so that seems like pretty good. But on the other hand, it's almost more of a personal choice, as you said, and particularly the fact that they want to travel more, the fact that they may be thinking they shouldn't travel because they don't have the extra income. I think they're going to be fine either way. So in a way, I'd kind of rather have them take it earlier and travel if that's what they want to do. Right.
Yeah.
But I think they can, if they wait, they get a little extra income. I think they have enough of a portfolio. Now, if the market's going down at the same time where they're pulling money out, that's not going to feel good. I guess I kind of like your idea, Joe. Maybe you don't take it initially, test it out, see how it feels. And then if you want to take it 6 months, a year later, whatever, go ahead. I like that.
Yeah. This is just kind of like the opposite advice that we gave earlier too. I mean, I think this is why you can't really have cookie cutter advice. Every situation is so different. I think the first question we had is like, all right, here the market fell, the market tanked, so I'm going to take my Social Security because I have $5 million or whatever. How much money did that guy have?
I want to say about 3.
Yeah, I mean, it was a ton of money. It was several
Yeah.
$1 million.
Yeah.
It was like, here, I want to take it. It was like a knee-jerk reaction
Yeah.
because of the markets, and he got kind of scared or freaked out. And it's like, well, no. I mean, if you have a strategy in place, I think for him, it probably makes sense to delay it. He could take it, but he had plenty of cash or plenty of capital, so it didn't necessarily matter all that much. I think the Social Security benefits to this couple means a lot more to them.
Yeah.
Not saying that it doesn't mean, I mean, they don't have $5 million, right? They're like
Right.
all of us. They have $700,000, $800,000. It's a really strong nest egg, but they can't make a ton of mistakes.
Yeah.
They're at a 3.5% distribution rate. So, I mean, if the market tanks and they're taking more out, I mean, you're going to see that balance, go down a lot more. It's gonna affect them a lot more than it would be with someone with millions of dollars.
Yeah, and I will say we do get a lot of questions from people that have millions, but to be really blunt and honest, 700,000 of a nest egg is an amazing nest egg. I mean, that is so far above the average person, it's ridiculous. So you've done a great job, and it's a little bit of a personal choice. You could take it now, you could take it in between, you could take it at 70. I think me personally, I'd probably wait to 70. But the fact that I don't want you to not travel. So if you're going to feel like I can't travel till I take Social Security, then take it, right?
All
and
right.
by the way, you didn't give advice earlier or now you spitballed.
Thank you. Did I say advice?
Yes.
Oh.
It's been a long day. It's okay.
Oh, here, let's do these other ones real quick too. Should the 401k contributions go into a Roth? I would say yes right now.
Yes.
And should we do Roth conversions? Possibly, but I would say that's more of a decision when she retires and you take a look at it and see what makes sense.
I don't understand how to figure out the tax rates. Well, let's help Kelly figure out tax rates. So let's see. Kelly.
So she makes 80,000 a year.
Husband's retired.
Yep.
And he's got a pension of $4,000 a month, so $48,000.
Yeah, so we'll say by the time you add that up and whatever other little amounts they have from taxable, it's probably near the top of the 12% bracket.
So you add up 48,000 and
Plus
80,000.
Yeah, 128, and then let's call
minus
it
30,000 for
Yeah.
your standard deduction.
right. Put you right around 98,000, which is right at the top of the 12% bracket. Which
So if you go to like the IRS, so how the tax brackets work, they're marginal, and I think a lot of people get confused here. So if you look at married filing jointly, so $0 to $23,000, is that married? Yes. Of taxable income is going to be taxed at 10%. And then 23,301 or 201 to 94,300 is going to be taxed at 12%. So the top of the 12% tax bracket is roughly $95,000 of taxable income. So there's a standard deduction, which is around $30,000. So you take your gross income, which Kelly and Steve have, of about $120,000. You minus the standard deduction, which is roughly $30,000. So 120 minus 30 is 90. So out of the $90,000 that Kelly and Steve have coming into the household, the first $21,200 of that $90,000. So let me just round. The first $25,000 of the 90 is going to be taxed at 10%. The remaining will be taxed at 12%. So it's stair steps. So some is going to be taxed at 10, some is going to be taxed at 12, and then if you had additional dollars above the 12%, those additional dollars would be taxed at 22%. So when we say you want to convert to the top of whatever bracket, is that, well, you're still in this bracket and you might jump a bracket, you might go into a higher tax bracket later, or tax rates might go up. So it might make sense to buy that tax cheap today. So go to the top of the 12, pay the tax, get that money into a Roth. So when you're thinking about Roth conversions, you want to look at what tax bracket that you're in today, forecast what tax bracket you think you're going to be in the future, and then that's going to determine your conversion strategy. And how to kind of determine the amount is just looking at the tax tables that the IRS publishes, and then looking at your tax return and looking at taxable income, which in 2024 now is what, line 10?
could be. we don't have the return in front of us. I will, for our engineers, Joe, you quoted 24 rates. So the 25 rates is about 97,000. That would be the top of the 12%.
Oh, yeah, that's right. I did.
Welcome to 2025, Joe.
I didn't know. It was 24. I thought that was off.
Yeah. Yep. You're close, though. That's within a few thousand.
Yeah, those were the 24 rates.
Yeah.
There you go. I was looking at my key financial data guide of 2024.
Right.
We've got them going
So you
back all
can
the way to like
download the
2010
key
or
financial
something.
guide of 2025.
Check the link in the episode description to download your copy of the Key Financial Data Guide. We'll make sure you get a copy from this year. Join us next week as our friend, the founder of HumbleDollar.com and former Wall Street Journal personal finance columnist Jonathan Clements returns to YMYW with a new initiative to turn young adults into lifetime savers and your chance to get a free copy of his latest book. This is Your Money, Your Wealth, Your Podcast. If you enjoy YMYW, do us a favor and tell your friends. It helps us reach more listeners like you. And don't forget to leave your honest reviews and ratings for Your Money, Your Wealth in Apple Podcasts and join the conversation in the comments on our YouTube channel. If you're among the 44% of our YouTube viewers who haven't done so, help us out by subscribing to the channel and turning on notifications. Your Money, Your Wealth is presented by Pure Financial Advisors. Your retirement deserves more than just a few minutes of spitballing. Get a comprehensive financial assessment with one of the experienced professionals on Joe and Big Al's team at Pure, either in person or online. They'll work with you to customize a plan for the retirement you deserve. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this podcast and does not represent that the securities or services discussed are suitable for any investor. As rules and regulations change, podcast content may become outdated. Investors are advised not to rely on any information contained in the podcast in the process of making a full and informed investment decision.